let's begin specifically going into our revenue cycle. We're going to have a good time, and this is going to account for all components of it. We're going to see our accounts receivable, our sales, and here are items that relate to both of them. Let's take a look. Well, what is our component, right? We've got mainly two components. We sell things, and then we are owed money by customers, and then we collect that money, hopefully, obviously. Let's start with sales, just because generally we sell something that's going to be more associated with the income statement. Then we've got our balance sheet. We sell something, and then it's owed to us. Starting with sales, that related assertion is going to deal with transactions. Now, we've got these concepts of assertions relating to account balance, transactions, and presentation and disclosure. We're going to see that commonality. Those are essentially the three groupings. And let's think about that for a second, because account balance, that's the balance sheet. Transactions, that is the income statement. Presentation and disclosure, that's essentially the notes to the financial statements and overall making sure that everything is properly disclosed and presented in a way that's understood. We're going to see that commonality between all of these different cycles because each one is going to have a component within these three portions. Starting off with sales, well, how do we test completeness, right? We're going to see, here are our assertions and how are we going to essentially test for them? Well, we see here that we are dealing with the assertion of transactions. This is only going to have certain of these overall management assertions. Similarly, with our account balance assertion, that is only going to have some of the management assertions. Let's kind of dive in there. First, for completeness, we can trace the sample of shipping documents to the sales invoices and sales journals to the accounts receivable subsidiary ledger. So if we take a look at the shipping documents could say, we shipped 20 pieces of inventory. That should tie to the invoices, to what we are trying to bill the customers, and the sales journals to the accounts receivable ledger. Think about your journal entry, right? Your journal entry is going to be a debit to accounts receivable and a credit to sales revenue. You thought you'd escape journal entries, but oh no, you will not. I mean, there have been sims on this exam that have to do with journal entries, and I would, whenever you get the chance, be as familiar as possible with your journal entry. So that is going to be an example here, because whatever you debit, maybe you debit $10,000 for AR, you should credit $10,000 for sales. That should match up there. Now for cutoff, we want to make sure that sales are appropriately recorded in the proper period, meaning if a sale happened on 12/31, right, at the end of the year, we don't want to accidentally include that in the next year. We want to include that in the correct year, which would be this year if it happened this year, whenever that sale actually happened. And in order to make sure that everything is properly recorded in the period in which it happened, we want to compare sales invoices before and after year end with dates recorded in the sales journal. We want to analyze sales returns after year end, because if a sale was returned, then it's obviously not a sale anymore, and we need to account for that. Want to make sure, again, just to beat that to death, because why not, that any sale is recorded in the year in which it actually happened. Now, how are we going to deal with the valuation, allocation, and accuracy of sales? We want to compare prices and terms on sales invoices with authorized price lists and terms of trade. We want to make sure that, okay, yes, we sold 20 pieces of inventory, and let's say, okay, like we want to recalculate this kind of also. We want to make sure that it's appropriately and accurately recorded. Maybe each item was $10. So we've got 20 items, each for $10. So we've got a $200 invoice. Now we can compare the prices. We can, maybe go on the client's website, look at what it should have cost. We can look into their internal accounting system and see what the prices are listed as there. We want to look for the authorization of the sale. We want to look at the terms of the trade. If it's possibly a bigger sale, we've got a contract going on there. So we can compare and make sure that the amount that's recorded is actually the amount that was billed. It's actually the amount that the customer saw. For existence and occurrence, making sure that something actually did happen, we want to vouch sales transactions from the sales journal to sales invoices, customer order, and shipping documents. All of these should add up. The sales transactions in our general ledger should equal what you see in the sales journal, which is specifically where you're going to see all these transactions. The sales invoices should list out all of these as well, right? The invoices should reflect what you see in the journal. The customer order and shipping documents should all include, again, the same amount. There's 20 pieces of inventory for $10 each. They should all match up. So just think, you've got to get familiar with all these pieces of audit evidence, all these documents that you would see in the normal course of business, and remember which ones you should see together, which ones should match each other. Lastly, here for sales, when it comes to transactions, for understandability and classification, we want to examine sales invoice for proper classification of revenue accounts. If it's unearned revenue, if it's earned revenue, if it's contract revenue, service revenue, physical product revenue, that's something we want to make sure that we break out properly and obviously classify in its correct form. Now, if you're feeling like this may be a lot, you are totally right. I'm going to be spending a lot of time going through the details here because, well, what kind of instructor would I be if I didn't go through and kind of analyze and assess each one? It is quite mind numbing. And if you need a break, obviously take them as you need to. But I want to make sure I detail in each instance what each document is, how it ties to our financials, how it relates all together. And with that being said, let us now move on to our accounts receivable, which is going to be related to the account balance assertion because it's on the balance sheet. It's a point in time. And we're going to see this related to completeness. And how are we going to test for that completeness assertion? Well, we are going to trace the total of the aged trial balance of accounts receivable to the general ledger control account. Essentially saying we have our accounts receivable. We know we're not going to collect all of that. Our aged trial balance of accounts receivable is going to reflect that, is going to reflect, okay, over what period of time do we expect not to receive certain amounts in our accounts receivable? And we want to compare that to the general ledger control account. Next up, valuation, allocation, and accuracy. How are we going to test that for accounts receivable? Well, we want to examine confirmations and test the adequacy of the credit worthiness ratings. Because accounts receivable, what's the biggest factor that is going to determine the valuation of them is going to be our possible aging schedule and the fact that we may not receive them. It's going to be our allowance for doubtful accounts, the fact that we have to write them down. And just as a note, obviously we'll get to this in a second, but looking at the presentation and disclosure, well, for the valuation, allocation, and accuracy here for sales and accounts receivable, a lot of this is just going to say read the footnotes, right? Just make sure that all the disclosures are included, make sure that everything's properly, obviously categorized and everything. So we see here, this is very much more, is everything properly disclosed there? Can we understand it? Here, we're actually going to do heavier testing to make sure numerical amounts are correct. How do we confirm the existence and occurrence of accounts receivable? Well, we want to confirm a sample of accounts receivable. We're going to send out those good old accounts receivable confirmations to third parties, those customers. For rights and obligations, how do we know we have the rights to our accounts receivable? Because you can pledge your accounts receivable, use them as collateral and borrow against them, or you could sell them off to a third party who is an expert at collections and maybe works, again, for collecting those accounts receivable. So you sell them off. Maybe you sell $100,000 worth of accounts receivable, give them to someone for $80,000, and you just took a 20% loss, but the thing is you got the cash right there. Well, in that case, you actually would not own your accounts receivable anymore. You got rid of it. So that's kind of the big deal here, is making sure you're not listing accounts receivable that you don't own anymore or that you kind of give up the rights to. How are we going to test this here? Well, we are going to review bank confirmations, make sure that those who say they owe you amounts actually owe you the amounts, and debt agreements for any liens on receivables. Make sure that any debt you have is not contingent upon giving up your receivables at any point. You're going to inquire of management. You're going to obviously ask management, say like, hey, is any of this tied up in any loan agreements? And then read the board of directors meeting minutes. What are we going to do when it comes to our presentation and disclosure? Well, as I said, most here is going to be just make sure, okay, anything required is included. You're going to read the footnotes. That's what you're going to do. You're going to compare audit evidence to determine the occurrence. Really just kind of like, I'd say, giving a nice overview, right? A nice overlook of all the financials. We're going to deal with occurrence here. Yes, like did everything that occur actually get presented properly and disclosed? We're going to determine if receivables are pledged, assigned, or discounted. Lastly, just read the required disclosures, make sure they're understandable, make sure they're properly classified. Let's talk about the components of the revenue cycle. Well, a general assumption of the revenue cycle for the exam, as well as for many large companies in practice, particularly business-to-business companies, meaning you got a large manufacturing company doing business with another large company rather than doing sales with individual customers, right? So again, like what's the assumption is that, we're not talking about Best Buy selling to individual customers. Now that's a component of what happens in the cycle. But when we're talking about the revenue cycle and accounts receivable, we're thinking of it, we've got large companies selling to other large companies, and that credit sales are the norm, meaning you give terms on credit and you're not transacting in cash right away. Because with large companies, no one wants to pay up cash right away. If you're dealing with millions of dollars of cash each day, millions, hundreds of millions, something like that, right? It makes sense. You want to invest that money because we're talking tens of thousands of dollars, possibly per week in interest expense and possible interest income for investing that money. So again, that's why you don't want to really give up your cash right away. Giving up your cash right away, cash is king. Cash is power. You can do things with cash and time value, money, all those concepts come into play. So with this, we are going to deal with usually in increments of 30 days after the sale. So the terms of the sale, if we sell a bunch of metal sheets, we're in manufacturing, we're selling metal sheets. Our customers are going to owe us money. Maybe the terms will be 30 days. You owe the money in 60 days, 90 days, or 120 days. And we do not assume that these customers are paying these companies cash at the date of sale. We're doing these credit terms. Now with that, just like if you're buying a car on credit, right? You're not paying cash for that car up front. They do a credit check on you. A lot of these companies will have full-on credit departments that if they are making a large sale to someone, you're doing a credit check on that other company to make sure if we sell that customer the metal sheets, do they have a good credit score and are they likely to pay us back? Now, I think it's pretty likely that if we sell something to Microsoft will pay us back. However, if startup ABC just started and has no financial history, then okay, that's probably not the best. And if they've got a massive amount of debt and they might not be able to pay us, that's also a red flag. So that's what the credit department would do, is assess each company, say, should we even sell to this person? Because if we do, are we going to get our cash? And so we want to make sure we collect on everything. The revenue cycle here is primarily going to consist of sales, accounts receivable, and cash receipts, as we talked about. For the revenue cycle, we will cover assertions relating to sales and accounts receivables, as assertions related to cash receipts will be covered in the cash cycle later on. Right, that chart we just looked at on the previous slide, we didn't really cover anything cash related because we got a whole portion for that. And lastly here, a great way to test many assertions is to think of the journal entries. As I mentioned before, your journal entries, you're not getting escaping them on audit. In general, journal entries are great. They never lie. Trust the system. A lot of people like to try to avoid them at all costs. Fortunately and unfortunately, I think they are very important. For example, to test the completeness assertion over revenue, I kind of touched on this a little bit earlier. An auditor could compare the credits to revenue with the debits to accounts receivable. Because if we want to make sure that all revenue is properly accounted for and it's complete, well, like I said, if we have a debit to accounts receivable, we have an overall debit balance of, let's say, 25,000, and if we have an overall credit balance to our revenue, and that's maybe 200,000, that's a pretty big variance. And you think, okay, where the heck is the rest of the accounts receivable? Because when you make a journal entry, it should generally be for the same amount of both of these. So if they're widely different on the trial balance or on our period ledger, then yeah, there's probably an issue there, and you're going to need to investigate further. So as credit sales consist of a debit to AR and a credit to revenue, these balances should be relatively close in an amount over a certain period, right? So if for the month of June, all of the debits to AR were only 25,000 and all the credits to revenue were 200,000, you'd say, okay, where the heck is the rest of the 175? Now, I mean, if let's say these amounts were, let's say, when should I change? If I change the debits to AR and I make those 201,000, well, the fact that it's $1,000 off, that's not too much of a concern. There's many reasons for why your AR could be slightly different than revenue in the real world. Not to get into those, but yeah, if it's off by $1,000, we're not too worried. If it's off significantly, then yeah, we should probably.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.